What's going on, everyone? It's Nick with Us versus Herd. We are going to be live streaming the Fed event of what is going on today. Seeing what's going on. If you're here in the chat, say what's up. Glad to be back. Glad to be here. Today is I think today's going to be crazy. Today is going to be crazy. I'm just making sure. I haven't live streamed in a minute, so I'm making sure my settings are all good. But getting right into the action right now. The main thing that we're concerned about right now, or what the Fed is concerned about after it not cooling down. This is the CPI data. Terrible chart. There's really no flexibility here, but it was reported just the other day that we went from 8.3 to 8.6 after the Fed said that we are cooling down inflation, and because now it appears obviously that's not the case. So they keep thinking we're cooling down, and this is why many believe the Fed has to start getting aggressive. I mean, the thing is, like Powell has been, at the very start of this, when inflation's going up, or we'll pull this chart back up, they kept saying inflation doesn't exist, and it kept going higher and higher and higher. And now the issue is the Fed is chasing inflation. Now inflation is getting very, very, very serious, right? And we're starting to see it. I mean, paying this much for gas, this much for food, all of this stuff adds up. Paying this much for rent or for your mortgage or whatever the case is. That right now mortgage rates are tipping over 6%, and depending on today's decision, I mean, these could go these mortgage rates could go 7-8%, right? So I mean, we're in big trouble in terms of the economy, where our country is headed, at least economically speaking. In terms of the stock market. And there's yesterday Redfin said they're going to lay off people. Compass is going to say lay off people, and Redfin actually started to say that this is going to be most likely not just a few months, but a multi-year downturn in the housing market. They're not hitting quotas, they're not hitting anything, right? They expanded way too fast when everybody was just like grabbing homes, and now interest rates are so high, people are not buying. But the good news is Powell is starting to accomplish some of the things he wants to slow down the economy. That is how we're going to tackle inflation. However, we're not seeing that yet in the CPI data, which is why he's got to get a little bit more aggressive. I mean, the market right now, it's up. We got S&P up 33, Dow's up 150, Nasdaq is up 190. We got about 6 minutes until the CPI data comes out, or not CPI, the Fed interest rate numbers come out. So we were saying, everyone's speculating that it's going to be 75 basis points after, assuming it was going to be 50. Powell started off with 25, then he moved to 50. Now we are at 75. Like, for me personally, let's get this thing over. Do 100, 150, bro. Let's do it. You know what I mean? Do 100, 150, and let's get this over with. Like, we don't have to. If now that you're chasing, like, my opinion, this is all my opinion. Now that we're chasing inflation, we need to stop it dead in its tracks. We need to do whatever it takes, and we're gonna see today. This is why this is so important, because the Fed has been, I guess you could say, lying, but maybe they're not lying. Maybe this is what they truly believe. But right now, the trust in the Fed is under zero. We're under zero for trust in the Fed. So the Fed has zero credibility. The White House administration has zero credibility. Nobody's doing anything. Everyone's just saying, "Oh yeah, just you gotta withstand it because it's the Putin price hike is what they branded it, right?" But we had these issues. We were gonna have these issues since 2020 when they started printing, in 2021 when they started printing all the money, right? So apparently Sky News tweeted, then deleted a tweet saying it's 75. So this is what I think. Like, if I think it will be bullish for the market if it shows that Powell is getting very serious about this. If Powell comes out weak and says, oh, 50 basis points, or hey, we'll see what happens, very wishy-washy, I don't think the market's going to like it. Now, it doesn't really matter what my opinion is. The price is whatever the price is going to be. But like, that is my opinion. I don't have any positions out right now. I did a couple trades this morning. I'm out of the market, so I'm just waiting and seeing, what the situation is here and what Powell has to say, and kind of see how the market digests. I mean, how we've seen in the past is the market is playing out exactly how it's been in the past, where we have a green day, we rip even higher, and then we just plummet to the ground into the afternoon and then the next day, right? So is it going to be a repeat of that? I mean, right now we got a nice triple top forming here on Nasdaq. It's gonna be. I would say it's gonna be interesting. Like, anything could happen, and for me personally, I've never traded under these type of situations, right? Where, I don't think anybody has. Right now, we have the Fed tightening at the worst time in history. This should be a time where the Fed is starting to loosen to start stimulating the economy, but instead we're going the other way, so we're tightening into a downtrending economy where, I guess we'll see how it plays out. You know what I mean? But I think now the market is expecting 75. I think if he gets aggressive, I think it would be bullish for the market. But it kind of all depends. I mean, we're looking for, at least for me, I'm looking for Powell to kind of grow a spine here and say, hey, we're gonna, and he's been saying we'll do whatever it takes, but he has not solved any issues. We're in trouble here. The worst nightmare. Inflation goes 10%, CPI goes 10%. We all know, like, inflation is way higher than CPI data, but the CPI data goes 10%, 12%, 15%. I mean, we are going to be screwed. We're going to be screwed big time, So, not that we're not already, but we had Costco cut me off at $100 in the tank today. You can't. You can't even fill your tank. It's bad. They don't, even if you have the money, they don't let you fill it. All right, looks like the algos are reacting to some news here. I don't know if this was based off that leak you guys were mentioning or not, but algos are moving here. Right before, we got about a minute and a half until the data comes out, and then Powell's going to give a speech. So, this is gonna be interesting. I'm not nervous. I'm like, I guess in anticipation. If you guys could do me a big favor, hit the like button. I would definitely appreciate it. Helps out the live streams, helps out the channel. Definitely appreciate you guys tuning in. I've been trying to make more content and just try to be more involved with you guys as a community. All right, we got less than a minute before this is going to come out here. What do you guys think? Are we going to go? Are we going to rip high? Are we going to be in trouble here? What are you guys thinking? Yeah, the market's going both directions. We know the White House sent out $1 billion today to Ukraine. Yo, Nando, what's going on? What's going on, Dustin, Jeff, Fred, Ben, EG, Sinister? How you guys doing? 200. Kevin says 200. Woo! All right, what's the consensus here? Federal Reserve hiking rates by 75. Let's see here. Let's bring this up. I don't think. Let me try to pull this. Let me try to pull up what CNBC's got working in the pipe here in terms of price action right now. Okay, so we're a little bit booming right now. It says Fed hikes its benchmark interest rate by 3/4 of a point, the biggest increase since 1994. I mean, this is wild. So we'll see what they say about this, and then we're gonna also tune into Powell here. I mean, if you're trading, if you guys are trading this, just be careful. Anything can happen right now. Yo, Dustin, what's going on? If you're here, say what's up. Just excited overall. Thanks for streaming. Yo, appreciate it, man. Appreciate it. That's what we're here for. Just trying to make the community better traders, better versions of us every day. We may not be green every day, but we're not going to lose our shirts either. I mean, I think if there's a community that has the most resiliency for this market, it's us versus her. And I may be biased, but I think it's just because, you know, we keep it realistic. We keep it realistic from the beginning of, like, you make money, you lose something. It was nothing. I never said, like, oh, you're going to make thousands of % every day and you're going to be a millionaire overnight. I've never said that. And I think the people that want that are not here. And the people that wanted that are also probably no longer trading. Am I right? All right, so we got VIX. VIX just shot straight up from 30.5 to 32.6. This is gonna get crazy. Yo, David Hood, sitting on hands. Good idea. Sit on those hands. If you are the type of person that, like, has to trade, go out for a walk, come back tomorrow, go golf, go do something, get a hobby. If trading's your hobby, you're gonna be in trouble. You are going to be in trouble. So let's see what's happening here. We got VIX skyrocketing. Ending weeks of speculation. The rate-setting Federal Open Market Committee took the level of its benchmark fund rates to a range of 1.5 to 1.75%, the highest since it's just before the COVID pandemic in March 2022. Additionally, members indicated a much stronger path of rate increases ahead to arrest inflation, moving at its fastest pace going back to December 1981. According to the dot plot of individual members' expectations, the Fed's benchmark rate will end the year at 3.4%, an upward revision of 1.5% points from the March estimate. So they're going to be at 3. They're as of today, they're estimating the rate will be at 3.4%. We're right now at 1.75%. So we're expect a double. Expect a double, essentially, is what they're saying here. Officials also significantly cut their outlook for 2022 economic growth, now anticipating just a 1.7% gain in GDP, down from 2.8% in March. I mean, these guys, I can't. The inflation projection is gauged by personal consumption. Expenditures also rose to 5.2% this year from 4.3%. Energy costs, I mean, it's just, you know, I mean, you guys know the story here. Let's see here. It says, overall economic activity appears to have picked up after edging down in the first quarter. Job gains have been robust in recent months, and the unemployment rate has remained low. Listen, you guys got to look forward. You got to look forward here. There's massive layoffs coming. There's massive layoffs happening right now. We know what happened in the past. Everybody was fine. To make money, you got to think about the future. To predict, you got to, you know, why do you think the Titanic crashed, right? It didn't see ahead. It wasn't looking ahead. Sorry, I'm getting heated. Indeed, the estimates as expressed through the committee's summary of economic projections see inflation moving sharply lower in 2023, down to 2.6%. Yeah, because they know at this point they have to crater the economy. Like, you have to crater the economy. This thing's selling off now. We got VIX going. Like, don't get trapped in this, guys. We got SPY down at 375 now, TAP 380, 375 now. Nasdaq's going nuts. I mean, just be careful, guys. If you're trading. Longer term, the committee outlook for policy largely matches market projections, which sees a series of increases ahead that would take the fund's rate to about 3.8%, its highest level since 2007. Banks use the rate. Okay, we don't care about that. First quarter growth declined at 1.5% annualized pace in an updated estimate Wednesday from the Atlanta Fed through its GDP Now tracker put the second quarter at flat. So they lowered it to flat from 1.5% to 0% GDP growth is the estimate. You know what happens after 0%? It's negative GDP growth, contraction. And that's what we're starting to see with homes, used car prices, and jobs. Like, I think, my opinion, this is going to be, this winter is maybe the hardest winter we may economically go through in a very long time, that we have in a very long time, at least in my lifetime. I mean, sure, I've been through the Great Recession, stuff like that. I was still young during the tech bubble. I wasn't trading. But this, I think people are so optimistic about the economy, especially the leaders and also people that you talk to. Like, I don't know if you've talked to people, but right now, because everything is fine, oh yeah, my job's secure, 401k is secure, everything's fine. I can still make it. Sure, things are a little bit higher, but I can still afford to pay it. As long as you have that job and you're not eating into your savings, right? So I think where things are going to get tough is this winter. This winter, things are going to get tough. And where I think July, August, September, leading up to the fall and winter months, we're going to start seeing major contraction and major layoffs. At least that's my prediction. I mean, I don't want this to happen. Like, I don't. But as a trader, as an investor, as a person, as a business person, as an entrepreneur, you got to look, like I've been saying, you got to look ahead. You got to be able to look ahead and see. Otherwise, we're all going to be in trouble. We're all going to be in trouble. But as traders, we can navigate this. We can come out green. We can come out profitably. We'll be able to, if we lose our jobs, we lose our, whatever it is, we can still generate money within the market. We can still use the market to our advantage, even if it is going down. And we have been for the last 6 months. The market's been going down 6 straight months. Yeah, I don't know. VIX is broken here. It went up from 30.5 to 32.5, back down to 31. We're selling off pretty big right now. We haven't gone red yet. Oh, Dow went red. Nasdaq's at 87. We got S&Ps here, just barely hanging on. And just so you know, so we have Powell's speech coming on about. I'll put on Powell's speech here in like 20 minutes or so. We have Powell's speech. We have Powell's speech coming on that we got to get through as well, and that will most likely move the market. What do you guys think? I mean, we kind of anticipated this kind of price action. We had a spike, then we're having the sell off, and we'll see. I guess we'll see if SPY's speech can actually. Yeah, Jeff, what happened to VIX, man? Like, what? That is crazy. Yeah. I know Amazon was up pretty big today. Right now, it's still up 2%. But it got smacked. Still back where it was consolidating here earlier today, like 104, 105. Yeah, this is definitely very, very dicey. Yeah, I mean, if you're trading this, like, you're probably having a heart attack right now. This thing's going nuts. So that's what we expected. Sometimes to make the most money in the market is also knowing like when not to trade. Like if you want to make money in the market, everyone thinks you have to have a position on, but you definitely don't. Sometimes when you have 0 positions on, you make more money than you were trading because you'd be a losing trader, right? So CNBC put together this whole document and they highlighted red what changed in the statement. So kind of interesting, like just overlooking at this, we already know what changed in it, but like Like if a teacher was grading this, I mean, you got an F, man. You got an F. If your teacher was grading your report and you had to make this many revisions, I mean, you failed. You failed. And I think the worst part about all this, is that rich people are going to be fine because they made so much money in 2020 and 2021. The middle and the poor class are always going to have to be the sacrifice. Always. The rich people will be fine. And the politicians, they'll be fine. Nancy Pelosi, she may be down 46% on her latest calls, but she's going to be okay with her, $100 million net worth, right? So, these people, they don't really, they're not working for us, right? They're working for themselves and their friends, and that's what it is. And that's why it's not relatable to everybody in every class. But when things go wrong, it will impact the lower classes the most. And I'm not preaching for like equality or anything like that in terms of, I'm not saying to tax the billionaires. As an entrepreneur, I think more risk, more reward, capitalism. But the people in power that are making decisions for the people that don't have much, something has to change. And instead of the politicians pointing the fingers at the billionaires and the people that are creating jobs, we should be pointing the fingers at the politicians and saying, hey, why are you not working for us? It's not the billionaires' fault necessarily. I mean, sure, maybe some of it's their problem, right? But the politicians that make the policies that impact everybody in America is causing major issues. High interest rates are going to impact the people with the most debt. Who has the most debt? Lower class, middle class. Because they don't have cash. They have the most debt. It's just what it is. I mean, I know I'm kind of ranting here, but... So, I mean, in terms of change, like how can we get around this is, leadership... We have had a lack of leadership for many years, and I'm not talking like, Biden or Trump or anything. I mean, it's been before that. We had a lack of leadership going into the Great Recession, then the banks blowing up. The banks wouldn't have blown up if we had good leadership and good policies, right? If you have people working for different income classes, sure, not everybody could be rich, not everybody could be poor, not everybody could be middle class. But you need someone on your side to work for you. In Nancy Pelosi or, Elizabeth Warren, they're not working for you because they, at the end of the day, they're the ones sitting back and, with their private chefs, and they've never been to a grocery store in 30 years or more. So it doesn't hurt you to make those kind of policies. Sure, people get angry, but anger fades, right? And then they get reelected. But I think it's gonna be interesting, how this all, especially for younger people that got burned by the market, how this all plays out, especially like in crypto. Whew. Oh my gosh. I'm gonna try to find the Powell speech here. Trying to find the channel, guys. Hold on. All right, let me know if you could hear. Let me know if you guys could hear this music coming through. Can you guys hear that? That's from the video. Can you guys hear that? Let me know in the comments. Okay, good. I'm just going to unless you like those chill vibes. I'm just gonna pause that for now until we can see until Powell comes on. We'll kind of watch the market right now. Let's see, Apple. I mean, everything's trying to come back here, but we're basically back to flat here. VIX is coming down. All right, thanks for letting me know, guys. So I just put that on mute right now. Man, I want to thank you guys for coming to hang out with me today. It's definitely a lot of fun. Your link is better. What's your link? It's a different source other than the Federal Reserve. Like on YouTube, I try not to put like something that's like not official. Like at least here, I know it's from the Federal Reserve. You know, you can have like, you know. Also, I know the Federal Reserve is not going to copyright strike me, like versus like a CNBC or Bloomberg or something like that. Jeff, you're waiting for 3,800. And we went negative, but we're back up now. Well, Dow's back up. I mean, the S&P's been holding. Yo, this is crazy. And all day. So I was trading Nasdaq earlier this morning. Let's pull up Nasdaq. So I was trading Nasdaq earlier this morning. Made like $500 or so. So I was trading these candles like right in here, and we're still at that same price of where I was trading this morning, which is crazy. Sure, we went up or down, but we're relatively like, I closed my last trade. I was like I was at like 520 when I closed my trade. Now we're at like 535, 540. I mean, we're 20 points away from where I closed my trade. So if I held all the way from when I opened my trades to sure I'd be up money, but I would have a lot more risk than I should have. You know, it wouldn't be worth the risk. I was better just because I closed it out. I closed out on this spike right here, right in the morning. I closed out these initial spikes. I was done trading within the first 15 minutes of the day today, you know? So like, if you're like, oh yeah, if I held long or stuff like that. In this case, in this example, I would have made the same amount of money, but would have had a lot more risk. So that's, you know, your risk to reward ratio. You always have to balance your risk to reward ratio. What's the risk to make money? If the risk is too high, don't trade it. Look at GLD. Ooh, it's breaking out here today. I mean, we're still a little bit of a mess here. Let's pull up the 1 year here. I mean, nice support. Actually, is respecting support real nice down in here. Probably wasn't a bad idea to take a jab at some calls here, huh, Jeff? CW scalped a couple auto puts right at 2 p.m. Nice, 70 cents to 112. Nice gains there. Almost 50% gains there. Dollar's dropping, gold is up. Yeah, this is crazy. Yeah, I mean, I wouldn't be surprised if this retakes the 200-day here. Makes a push back up to 174, 175. I wouldn't be surprised. We got SPY at 376 still. It's holding, but we're just chopping. I mean, look all day. Like I said, we opened, like SPY opened up like 377.15 around here. It's literally just like 40 cents off. Yo, the bots are the bots are coming here. What the? Oh my gosh. Oh my goodness. The bots are here. Listen, nobody's trying to find. You know, we're traders. We're more interested in trading right now than. Yeah, Jeff. GLD looks like a very good risk to reward ratio. Speaking of risk to reward ratios, I mean, basically buying the bottom here. Listen, I don't know. Some dating it. Some. My ads are crazy. I'm not running anything. I don't know what's going on. You guys saying there's a lot. You guys are seeing a lot of ads. Like, I'm not running, I'm not pushing any buttons to run ads here. Like, YouTube's doing whatever it wants to do. If you guys are seeing ads, that's nothing, I'm sorry. YouTube is doing what YouTube is doing. If you guys are seeing a lot of ads, I don't know. YouTube is doing it. Looks like, I mean, it looks like we could launch off here, guys, but yeah, what is going on? Yeah, those bots, like, they're like cheap sex dating. Like, what the heck? like here, we're traders. We're not looking for any of that right now. We are not looking. We are some bot crashed the party here and just started spam the chat. Yo, if you're aiming at traders, you're in the wrong category. We're more interested right now in what the charts are doing than anything that bot or wherever those links lead to. Whatever that channel leads to. Yo, Chase, what's going on, man? All right, we got about 8 minutes. What are you guys looking at? We got about 8 minutes till Powell comes on. Yo, we got Boeing up. Boeing's up 9. Man, this thing got smashed. I haven't even looked at this. 142 to 113. Wow. Tesla's hanging on here. Bookmark for after 4 p.m. Well, cheers. Best of luck, man. Oh my gosh. Yeah, YouTube is crazy. Let's see how our friends JP and Morgan are doing. JP Morgan is struggling right now. Banks are getting hit. I mean, still green on the day, but not great here. Goldman. Let's see, how's this Goldman chart look? I like to trade Goldman and JP Morgan. Oof. Excuse me. Man. Let's see what we got here. We got looking over at the overall market, different screens here. Yeah, we might be in a little trouble here, guys. We might be in a little trouble here, guys. Heading into Powell. They're like, run! Powell's about to get on. Get out. Yo, are you kidding me with the ads? What the heck? Why? Who is doing this? Who is doing this? Stop it. Stop it. Yo. What the heck? What the heck? Why are they doing this? Why are these bots doing this? This has never happened. I've live streamed hundreds of hours and this has never happened before. And sure, I make one video about the Fed. Powell is trying to harass me. I got a word for you, Powell. I feel like I'm getting harassed. CW. Hey, do you, man, but like it's annoying. It is annoying. What do we got here? 37.50s. What do you think? You think Powell's going to crash the party, or is he going to give us the confidence that we need? Dominic, it does not. It does not. It does not. I guarantee it. You know, I'm up here trying to trade, try to see what the markets are going, and they're trying to, you know, They're trying to break me down, turning YouTube into a prostitution ring. I mean, this is crazy. Well, you know what, pal? You will not silence me. Ever. I've never seen this on the vids. We're going to see Nick get SWAT storming live. Listen, I'm not pulling a Jared or anything crazy, guys. I promise. I promise. This is wild. This is wild. Like, I don't even know what to say. I don't even know what to say. But right now we chopping. Right now, ES is below where, you know, basically where the market opened today. We opened when the market opened. We were at 37.75.76. We're down 20 points, 15 points from there. Where have you guys been finding success in the market? What tickers are you guys? What tickers are you guys trading? I've been primarily just trading Nasdaq. I've been trading some options here and there, but primarily sticking to Nasdaq futures, and that's been going. It's been going well. Like when volatility is high and things are unknown or you don't know what to do. What I always do, especially like what I did during the pandemic, is I just kept it simple. I just trade one stock, one ticker, one product, and just keep it simple. Maybe the spammers are traders too. Like if you're looking at like a lot of different stocks right now, like you're gonna have issues concentrating. How are Chinese stocks doing today? Alibaba, man, that was crazy. 127 to 97. Not performing great today. Chopping sideways. AMD, yeah, AMD has been a good one. AMD has been solid. But yeah, that fall from 100 to 80s, I mean, this is bad. This is bad. I mean, it hasn't hit the 52-week low yet, but I mean, it's not far. It's not far. I agree with you, Dominic. All right, Powell should be coming on like in a minute here. Been trading Nvidia and Boeing. Yeah, Nvidia is a stock I like to trade too. Man, every chart's the same these days. What a pig. Those chips, man. Oh, it did hit. Nvidia did hit a new low, 52-week low yesterday. I didn't even see that. I'm on SQQQ. Let's see where it goes in 1 minute. Yeah, let's see what Powell says. Let's see what's going to happen here. Yeah, I like trading the Nasdaq. I like trading QQQ, and I've always traded, for some reason, I've always traded QQQ better than SPY. And I trade Nasdaq futures better than S&P futures, ES. I'm always trading NQ. I don't know. For some reason, in like my brain, it just like works better. And that's why you have to go with what works for you. Just because someone has success at a particular stock doesn't mean you will. You got to find what works for you. Roku? Oh, Roku. Man, Roku. Up 9% today, though. This is surprising. I'm actually really surprised it's this high. Oh, my goodness. I mean, up 9% does not even put a dent to it. All right, the Fed started the live stream, but Powell's not up yet, so I'm gonna wait. I'm gonna wait for Powell to come on, and we'll put him on. He hasn't walked out yet. He's pulling a Sleepy Joe here, just an empty podium people look at for 45 minutes. Just so you guys know, politically, screw Biden, screw Trump. Like, I don't go for either side, okay? So, for those people that are thinking I'm pushing like a Republican agenda because of what I say or Democratic agenda, like, just relax. All right, he's on.
I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved
He's
resilient.
really reading this paper.
It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
We're going to pull up the market so we can see alongside the
Overall
Fed what's going
economic
on.
activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
Selling hard.
Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can.
75 basis points next
Our
time
overarching
as well.
focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Man, this is crazy. Crazy.
Thank you, Howard Schneider with Reuters. Two related questions, Chair Powell. Did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
I like this question.
So, as you know, we always aim to provide as much clarity as we can about our policy intentions. subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
So it's kind of showing he's being more aggressive now, which the market seems to be liking right now.
Thanks for taking our questions. Gina Smirlik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seemed like the right thing to do at this meeting, and that's what we did.
This rip is crazy.
Steve Leisman, CNBC. Thank you for taking my question, Mr.
Wow.
Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I would think about it.
But this 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be,
doesn't know.
You would
Just
have
say you don't
positive
know.
real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Nick.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode,
The
they
next
get
couple
back
of
down
years,
close
you
to
said.
2%. And so
Not
this is
months.
really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be.
Say yes.
The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy
He seems on edge. I don't know.
intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So, and I would hope that it's always going to be, any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out, and that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, very close to our meeting. Very unusual to one that would actually change the outcome. So. I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, 1 or 2 times. So I don't think it's something that'll come up a great deal.
Just aren't liking this.
Colby.
Pulling back a little bit here.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, but and right now our policy rate is well below neutral, right? So, soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, that you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, and frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand in take for example in the labor market. So you have two job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down,
right now.
you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
Lose their home.
So
What happens?
You're right. In the SEP, we have unemployment going up to 4. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%. That's still a historically low level. you know, we hadn't seen rates, unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that, you know, 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be, I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
You know, we don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, you know, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just a really, I mean, the labor market we had before the pandemic that's what we want to get back to. And you see, you know, disparities between various groups at historic lows. We'd love to get back to that place. But to get there, it's not going to happen with, you know, with the levels of inflation we have. So we have to restore that. And
You just said it would be successful.
It really is
if
in service
people lost
in the
their
medium and
jobs.
longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate and the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed. This means the FOMC is trying to induce a recession now to bring inflation down.
We're not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in, you know, prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't, the sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for, you know, such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear. What you're seeing is the situation getting more difficult. And you look around the world. I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects, and and we're seeing them here. Gas prices, you know, all-time highs and things like that. That's not something we can do something about. So. That is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to, to get rates up and ultimately get them to where we think they need to be in coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous month.
Well, I think we got enough out of Mr. Powell here. Market's up a little bit. I mean, this thing is crazy. SPY was, this thing went from 373 to 382. I mean, we've got 9-point, 10-point handles here. This is nuts. I mean, just crazy. So, I guess I'll let you guys get back to Power Hour. Thanks for hanging out with me. Links below if you guys want to join the Discord or the trading group on Facebook. As always, stay safe, stay green. It's us versus herd.